Hello, my name is Jeffrey Cutter. I am president of Cutter Financial Group. We specialize in low risk, low volatility, successful investment solutions, giving our clients a peace of mind. Today I would like to talk to you about how to tackle the American Taxpayer Relief Act of 2012 in 5 easy steps. This topic has gotten a lot of national attention with recent articles that I have participated in with the Wall Street Journal, Investment News, Kiplinger, Cape News. So let me get right into it. What is the American Taxpayer Relief Act of 2012? This act is a partial resolution to the United States fiscal cliff by addressing the expiration of certain tax provisions centered around what are called the Bush-era tax cuts. This act tackles the tax revenue side of the Congressional Deficit Reduction Plan, which was passed by the United States Congress on January 1st of 2013 and was signed into law by President Barack Obama on January 2nd. Step 1 of the 5 easy steps. We must understand the impact of income tax law changes. Roughly 98% of Americans will not be impacted by changes to the income tax brackets. However, individuals who file as single and make over $400,000 a year, or married filing jointly that make over $450,000 a year, will pay 39.6% income tax. Step 2 of this is we must plan for higher taxes in mind. The overall limitation on itemized deductions is back for those making $250,000 for single and $300,000 for married filing jointly, as well as personal exemptions will be reduced at the same limits. The payroll tax holiday that pretty much all of us have enjoyed expired, with Social Security taxes going back to 6.2% from 4.2%. Let me give you an example. If you make $100,000, you just got a $2,000 tax increase. So just because your income tax rate went up, it does not go up, doesn't mean that you're not going to pay more in taxes. In addition to the tax holiday expiring, there is a 3.8% healthcare surtax kicks in this year on net investment income over $200,000 for single and $250,000 for married filing jointly, along with a 0.9% surtax on wages at those same limits. Number 3, we must be aware of these other key tax law changes. This is important. The $5 million estate gift GST tax exemption, which will be indexed for inflation, and portability for the estate and gift tax exemptions are permanent features of the law. And the new top tax estate rate has climbed from 35% to 40%. Capital gains rates are the same except for individuals in the highest income tax bracket who will pay 20% tax rate. A permanent AMT patch index for inflation was also instituted. So for anybody who wants to know, the 2012 AMT exemption is $78,750 for married filing jointly and $50,600 for individuals. Number 4, utilize new provision for in-plan Roth conversions. You no longer have to be eligible for a distribution from your employer plan to go through a Roth conversion, as long as the plan has a Roth option, for example, a 401k to a Roth 401k. I spoke about this in a recent article in the Wall Street Journal on January 4th of 2013. Key points to consider. In-plan Roth conversions cannot be recharacterized. You cannot go backwards. You must make sure that you have the money to pay the tax on the conversion. Roth employer plans have required minimum distributions, also known as RMDs. You can utilize this provision for longer tax-free growth in the Roth plan. And lastly, celebrate the return of qualified charitable distributions, QCDs. They're back retroactively through 2012 and extended into 2013, but they're not permanent. They will expire at the end of 2013. Hope this is helpful. Again, Cutter Financial Group, if you have any other questions, do not hesitate to log on to cutterfinancialgroup.com. We have a wealth of information that you're able to tap into, including our blogs and information. So anything else we're able to help you, let us know. Have a wonderful day. Take care.